Hello, this is the Unemployed Value Degen. I'm not giving financial advice. It's been about 2 weeks since my last video, and my wife's a university professor and she was on spring break, so we went on a small road trip and I lost last weekend's recording time. And it's been a brutal time in the market. Oof, it has. I've not been having fun, but the 10-year Treasury is down from its highs. It's showing a little bit of relief. If this is really the trend line it's following, it gives us a chance of having a 3.5% Treasury sometime in 2026, and a 3.5% Treasury gives us a chance at a 5.5% 30-year mortgage, which would thaw out the housing market and really, I think, ignite a pretty explosive boom as people could take some home equity out of their homes and do something with it. Because interest rates are just a little too high for people to want to do that, and also interest rates are a little too high for people to want to move. You know, people are locked into their houses. It makes moving difficult, and remote jobs are not as easy to find as they once were. So I think that's where we're heading for in the medium term here, is falling interest rates and at some point an unthawing of the housing market. And it's started, but what's interesting is as the 10-year Treasury has fallen, the market has been crashing, and you know, oftentimes in the past, when the market crashes, people turn to 10-year Treasuries as a flight to safety, but I don't think that's really been happening. I don't see a lot of people out there eager to sell their Nvidia and their Apple in order to buy 10-year Treasuries yet. I don't think that flight to safety, because I don't think most people really believe that there's a recession coming. I think people think that Trump is creating uncertainty with policy changes, but I don't think people believe that there's an imminent recession. Not in a real sense, not an industrial recession. You could have a negative GDP print because of fewer government employees, but that's a very different thing from an industrial recession, which I don't think anybody sees happening anytime soon. We were just coming off of, I think, 3 years of the manufacturing indices printing below 50, and now for the first time they're recovering. So if anything, I think we're entering into an industrial expansion, but yeah, we finally have a falling 10-year Treasury. And we have some relief also in the dollar index. Now the dollar index has been, you know, where should I draw this channel? I think this was maybe the old channel, and we broke out of the old channel. There was a lot of people wondering if, give or take, not my best channel, there was a lot of people wondering if this line would have some resistance, if the dollar index is going to, say, bounce off of, call it this line here, and it didn't. The dollar has been weakening beyond that, so it's moving back into this old channel in the same way that I think this, I had originally drawn my 10-year Treasury line based off of these peaks, and that channel broke down with the spike outside of it. That spike outside of it, that was about when Stanley Druckenmiller said that he was shorting Treasuries. And I mean, that's a powerful force in the market when everybody jumps onto that trade and follows him. So you could think of this hump kind of outside of the channel, because maybe that isn't the you know, the fundamentals. Maybe that's just a pure flows phenomenon from shorts and short covering. The same thing could have been happening to the dollar strength, that maybe this longer term channel is still going to hold and we're just temporarily outside of it, but time will tell. As the dollar weakens, some of the international indices have had a serious rally. Not Brazil. Brazil's bounced a little bit, but Europe especially. And then the fearing grade index. So we've been at extreme fear for, is it a couple of weeks now? Yeah, so we've been below 25. We've been at extreme fear since February 25th. We've been at extreme fear for 3 weeks, just about. That's amazing. And like I said before, whenever you're in extreme fear in a bull market, it's a good time to buy something. This is just the S&P 500 momentum, price strength, breadth. breadth is deteriorating. Now the put-call ratio, and people are still buying a lot of calls for their long exposure. The put-call ratio isn't really a good measurement over time because the habits of retail participants in the markets have changed. A lot of retail investors are starting to use LEAPs, long-dated call options, for their long exposure. So instead of looking at the put-call ratio, sometimes I just look at the total put volume, and the total put volume is at a new all-time record. And I think it can be hard for the market to fall further when everybody has puts, because when everybody owns puts, then when the market falls, there's no need to sell because you're not losing any money because your hedges are working. And if nobody's selling, the market doesn't have to fall any further. But the total put volume is at a new record high, even though the put-call ratio isn't as high as it was back in July. But that's because people are also buying lots of long-dated calls still as well. And the VIX is above 20. It didn't spike above 30. It only reached about 27, 28. But the VIX is still above 20. Let's see. And the credit spreads. So credit spreads are still tight. And it's very hard to have a recession while the credit spreads are tight. You think that the bond investors are looking at companies, whether or not they're going to go bankrupt. And if they don't see any corporate bankruptcies on the horizon, then people are still buying junk bonds. The counter argument to that is you don't need to take this index very seriously anymore because of private credit. That all the real junk is in private credit, and what's left that's not investment grade is like the best quality of junk. I don't know how much to take that into account, because in this inflationary environment, fixed income is just easy to make those interest payments. Credit spreads are tight. I don't think anybody sees a real old-fashioned industrial recession on the horizon, even if we did have a negative GDP print from decreased government spending. And I don't even know that we're going to have decreased government spending, because so far it's only been increasing. So we'll have to see. But to get the 10-year Treasury back into the 3.5%, I think you might have to see DOGE, the Department of Government Efficiency, actually make some real progress. I think the bond market would like to see the government debt on a more sustainable path, and they'd like to see some of those 10-year treasuries refinanced at a lower rate so that our interest expense lowers. I mean, if you can cut $200 or $300 billion of interest expense out of the annual budget, that makes the government much more solvent. And that would become a virtuous cycle, right? The lower interest rate would allow the cheaper refinancing, which would make the bond investors happier and lead to a lower interest rate. And inflation has been not doing so bad. So if I look at the Truflation measure, because the CPI contains a lot of lagged housing effects, but Truflation is much more contemporaneous, and that just plummeted. It was up here at 3%. It's bottomed out at 1.4, but Truflation came down a lot. So we'll have to see what happens, but I still think it's a pretty good time to buy. When the market's at extreme fear, when people have bought a record number of puts, to me that tells me it's a pretty good time to just close your eyes and buy something. Over the last month, large growth has been the worst performer, but large value has been the best. So there's some sort of safe haven demand for large cap value. And small value has been taken out to the woodshed. This doesn't really show it because the small value, if we go out to 3 months, at 3 months you have small growth doing the worst and large value doing the best. Let me look at the S&P 500. It's in a real 10% drawdown, a real correction. It's below the 200-day moving average. You don't get too many of those in a bull market, right? So we have the bear market for 2022 with the rising interest rates. It was below the 200-day moving average most of the time. But we were only below the 200-day moving average, in the spring of 23 and the fall of 23, and now here in the spring of 25. So if this is still a bull market and I think that we're still in a bull market. We're in a global cutting cycle. Global liquidity is increasing. You're looking at deregulation and tax cuts in Washington, D.C. You know, I think the pathway is pretty clear for the bull market to continue. This is about as big of a drawdown as you need to have once a year. The rest of 2025 could be pretty nice if the bottom is in. I'm not 100% certain the bottom is in for large caps, but let's go ahead and take a look at, you know, this 10% drawdown was, you know, it was painful in the S&P 500, but take a look at the Russell. For one thing, the Russell was never up. So let's go back to the S&P 500. The S&P 500 had this great climb from the fall of 22 to now. The Russell 2000 small caps haven't had that, right? Small caps have been mostly flat, and then they had their peak. They had their peak last November. I'll go back to the 1 year. Right, small caps have been in a drawdown since the end of November. And the small cap drawdown, this is, I think last time I measured it was from the top to the bottom, it was 19%, not quite 20%. And I think it's possible, I mean, I'm not going to guarantee it, but I think it's possible that the bottom is in for small caps. Because you know the expression, they come for the generals last. Well, a lot of individual small cap stocks have bottomed out and have started to recover. What you typically see in a drawdown is it's the big stuff that get hit last and the small stuff that gets hit early. And I think we're following that pattern. If we just take a look at, you know, jumping the gun a little bit for a couple of names. Take a look at the chart on Advanced Auto Parts, right? It had its crash from 47 to 32, and now it seems to be starting the recovery. And it's too early to confirm it. If you look at Peabody Energy, same thing. It had its crash, right, and now it might be starting to recover. It was down here in the 12s, now it's up to 13. That is a brutal drawdown. But a lot of small cap stocks, and this could be a dead cat bounce, it could be a bull trap, but it also could mean the bottom is in, because you're going to see the small cap stocks, the individual names, start to go back into expansion again, start to go back into a bullish pattern again. While the large cap stocks are still getting crushed. So this is the Roundhill Big Cap Tech ETF. It's MAGS MAGS. That's below the 200-day moving average. I mean, this is not a terrible drawdown from 55.5 to 46. It's not the most painful thing in the world, but you're below the 200-day moving average. And then let's look at the NASDAQ. Yeah, NASDAQ looks very similar. You know, it's starting to have some resistance here. That could be a bear flag, but it also could be that the market has finished selling off for now, and that we can go back into that bull pattern again. We'll go back to the 5-year chart. Again, if we're still in a bull market, and I think we're still in a bull market, one of these 10% drawdowns, you know, just maybe coming below the 200-day moving average, maybe not, once a year is about all you get in a bull market. So there's decent odds that the expansion continues from here, whether you're looking at the NASDAQ or the S&P 500. Now the Russell 2000 chart looks very different, but the Russell 2000 has a bad composition effect. There's something else I wanted to show. This is the PE ratios of the different categories. And again, Russell 2000 has a lot of profitless tech. They have a lot of profitless biotech. But look at the S&P mid-cap. So the S&P 400 mid-cap, now the PE ratio is down to 14, which is below the 25th percentile range. Mid-caps are cheap. Now, and this is based on the 20-year average. The argument why you can't take the S&P 500 and the NASDAQ as seriously is because, or for a 20-year time horizon, why you can't say, okay, the S&P 500 should be trading around here in the middle, the NASDAQ should be trading around here in the middle, is because the composition has changed so much. There's so much more tech the tech companies have so much more growth, they're much more capital light. So as the composition for the last 20 years of the S&P 500 and the NASDAQ has changed, they could trade at a higher multiples. The companies are higher quality, they have higher growth, they have higher margins. They could have a higher multiple. But the mid caps don't have that same defense, and the mid caps are now even outside of the 25th percentile range. So there's things in the US that are cheap. You know, not the cheapest they've been in 10 years, but there's things in the US that are, you know, cheap on a relative basis. And I think the mid-cap index shows that. Mid-cap's trading at a PE of 14. And again, the Russell 2000 just has composition problems. I personally prefer small caps and individual small caps. Plenty of those are cheap. The index itself, I just think you've got much more of a tilt recently toward biotech and profitless tech. And there's a lot fewer of financials and industrials. I think the S&P 400 mid-cap might have more financials and industrials in it. But again, there are things that are on sale in the US. So if I could just go back to this graph, if we're still in a bull market, and I think we are still in a bull market, that's all the drawdown that you have to have. Now, are we going to keep on having a drawdown? I don't know. It's kind of anybody's guess. There's been 1 week of trading sideways after 3 weeks of trading down. That could be a bear flag. We could continue to trade down, but it would be very, very rare for a 20% drawdown when credit spreads are still tight. So I go back to the fear and greed index, and I go back to these credit spreads. If you count up the number of times statistically that you have a 20% drawdown in the S&P 500 with tight credit spreads, I think you get 0 occurrences of that. You still get 10% drawdowns when there's no real recession fear, but you don't get 20% drawdowns. So if this indicator is broken because all the risky stuff is in private credit and we have some big blowups in private credit and there's a real recession, then okay, you can get in the comments and say I told you so. But if this credit spread measure is still, you know, reasonably accurate, then I think there's pretty good odds that the worst could be in here. That it's, you know, the market is in extreme fear, the VIX is over 20. Just hold your nose and buy something. Let's look at some individual names. Now, in the individual names, I mean, the S&P 500 is down 10%, and I think a lot of people expected some give back in the data center build out in artificial intelligence and in NVIDIA. But what was really interesting about this one is on earnings calls recently, a lot of small cap value names on very moderate or mediocre earnings calls sold down 30, 40, or 50%. I mean, some names got cut in half on very, very kind of mediocre average earnings. And that was surprising. It felt like the Boston Strangler was let loose in my portfolio. And every morning I'd wake up and try and figure out, okay, which one of my stocks has he murdered this morning? It was brutal. So let's look at some individual names. The thing that has been keeping me afloat during this whole time is Medical Properties Trust. Medical Properties Trust. Let me go ahead and switch this back to Bollinger Bands. Oh, before I do that, okay. Correction, one thing. There's one indicator that sometimes predicts whether or not the bottom is in, and it's a volume spike. Let me go to 3 years, easier to see. So when you have a volume spike, it can indicate, you know, it's trying to figure out, is this a bull trap or is it the bottom is in? Well, when you have a volume spike, like we clearly have in this, you know, August of 2024, you have this huge volume spike at the low. That is a very strong signal that the bottom is in. And so when you're living in the middle of this drawdown and it starts to go up again, you say, oh, is this a bull trap? Is it going to keep on selling down? This volume spike is a pretty good indication that no, that is the bottom. And we look at this volume spike, and that was also a pretty good time to buy in the short term. Sometimes it fails to trigger, But this volume spike was a very good time to buy in the spring of 23. This volume spike ended up being a bear trap, but this volume spike ended up being a buyable dip, and they were, you know, pretty darn close to each other. There wasn't a huge drawdown in between them. Is this enough of a volume spike in this drawdown in the S&P 500? I mean, I wouldn't say that it's conclusive, but it's definitely much higher volume than the rest of the down days. So I might be happier if it looked a lot more like the graph looks here in August of 2024. But the volume of the S&P 500 on this drawdown for this last week, compared to what the volume has been recently, I think the bottom could be in. I think that the worst could be behind us. But I also think it's possible, again, they come for the generals last. So I think it's possible that some of the large cap names could keep selling off, but you're going to see a lot of the small cap names start to bounce back already, which is very common. You'll see small caps sell off first, and then they'll already be recovering when the large caps are still selling off. But the only thing that's been keeping me afloat in my portfolio has been Medical Properties Trust, which, and I've written about this on my Substack a couple times recently. I think most of their bad news is behind them. You know, the bankruptcy of their largest tenant, that process is over. The 15 new temporary tenants are in, and in 2025 they're paying half rent. 2026 they'll pay full rent. One of their other tenants, I think it was called, was it Prophecy or Prospect? I can't remember. I think it might have been, yeah, it starts with a P. But there's another bankruptcy process, but this one was much more friendly, and they have an agreed to settlement. I think the judge approved. So I think most of the bad news is behind them. And with most of the bad news behind them, the stock has traded up from about $3.50 up to about $6. It's, you know, let's see, is this, which color is this? So the 50-day average is red and the 200-day average is green. That's not doing it for me because I'm red-green colorblind. So let me fix that so that I can actually see it. No. Okay, let me do this to Bollinger Bands, simple moving average 50. What is the, how do I change the colors? Red, blue, red, blue, green. Try that. Okay, now I can actually see it. So the 50-day has passed above the 200-day. So there's a golden cross here. So the golden cross is positive, but the RSI being overbought and the MACD starting to decline. So there's some mixed signals here. You're at the top of the Bollinger Band. That tells me there's room to fall. The RSI is still high. There's room to fall, but you've had the golden cross. So, and there's a bit of a consolidation period here. I don't know what's going to happen in the near term. I'm surprised that the short squeeze was not as violent. So in two times previously, in May and in September, you had a pretty righteous short squeeze all the way up to $6.50. I thought this short squeeze was pretty tame. And the short float of this company is still wild. So the short float, 37% of the float is short, 14 days to cover. That is a huge short interest. 14 days to cover and 37% short on a stock that pays a dividend. I mean, anybody who is short this stock as of March 10th is on the hook for an 8-cent dividend. And that's painful to keep paying that. But the stock might not really get to the price level where I think it's going to get to until after they increase the dividend. And I have no guidance on when management will choose to do that. A lot of people saying, oh, they should not raise the dividend and do some share buybacks instead. I don't think they'll do that. They're a REIT and they know that they're a REIT. And I think that their only plan is to return capital to shareholders through dividends. But if I had to guess, it would be next quarter that they would raise the dividend. That would be a huge catalyst. But I'm very surprised that the price is below the two previous short squeezes. I thought it would have ratcheted much higher this time around. But I'm still happy that during this time period when small caps were selling off, I had my single largest holding, pretty close to doubling over that time. So that was nice for the portfolio. Finance of America companies. Finance of America companies, the earnings came out, and it had an amazing movement during that day. You can see the day that they released earnings because it had this massive candle and it bounced right back. So it's in this bull flag pattern. It had this, let's annotate it. All right, so you have this massive rally upwards, followed by this consolidation period. And the next question is, where's the next breakout? And it's been consolidating for a while. This last quarter, they were operationally positive, operationally profitable again. So twice now they've been operationally profitable, and they're guiding towards staying operationally profitable. That volumes were diminished after the banking crisis, and now they've cut costs and the volumes are up again, and they're operationally profitable 2 quarters in a row and guiding to continue on being that way. Now it's just a question of the mark-to-market effects in the portfolio. This last quarter was a tailwind or a headwind. The next quarter should be a tailwind. So as interest rates went up, the mark-to-market performance of their investment portfolio takes away from earnings. But as interest rates fall, well, then when it comes in next quarter, that should add to earnings. So for all the algorithmic traders, they're going to see some, ridiculous earnings number next quarter from the mark-to-market effect of their derivatives. And then the next question is, when do the residuals actually come in and they receive cold hard cash for those residuals? And I think the first one comes in April. So that's going to be on an earnings call 2 quarters from now. So next quarter has tailwinds mark-to-market, and the quarter after that has real cash coming in. The RSI, it's getting somewhat close to oversold. This bull flag, could be winding up for the next rally higher at any moment. But I was glad to see that on that earnings call, it sold off initially, I think because the quantitative programs went in and saw the generally accepted accounting principle numbers. But over the course of the day, retail investors that could read the report and use their brain came in and drove the stock price back up. So I was pretty happy to see that. I was anticipating the possibility that it could have sold off hard on that earnings call. So I've been on podcasts and I think on my Substack telling people, hey, this next earnings call, I don't know, but the next one should be pretty good. And I think that's about what happened, is this last earnings call was a big I don't know, but the next one should be good. New Fortress Energy. This stock has just been crushed. It was intraday, it was at like $7.50, and it was 16.5. This had an aggressive sell-off from 16.5 to 7.5. Now that is a beautiful hammer candle. Let me go in there for the 3 months. That hammer candle, that's 2 days ago now. What is that? March 10th, 11th, 12th, 13th. So this March 13th trading day, you have a day where it opens at about 8:50. It sells off for the first half of the day. The sellers lose momentum. The buyers come in and they drive it all the way back up and they bring it back up to the price where it opened at, and that makes a perfect hammer candle. And hammer candles tend to be a pretty good indicator that the bottom is in. And the hammer candle corresponded with RSI briefly touching oversold. And let me go back to a year. And you have the MACD rolling up. So with the MACD heading up, a beautiful hammer candle, and the RSI bouncing off of oversold, I think that at least for now, the bottom is in for New Fortress Energy, and the bottom should be in. Deutsche Bank came out with a report that was a downgrade on the price target, and they based it off of short-term liquidity concerns. And they have $427 million in cash, and they're guiding toward, if they don't get the FEMA settlement this year, they would be about $200 million cash flow negative, and they have $427 million in cash. if they do get the FEMA settlement this year, they'll be about $200 million cash flow positive. I don't know where Deutsche Bank is getting, you know, near-term liquidity concerns in a world where they've got so many things happening this year coming online, right? The Selba power plant in Barcarena, you've got Nicaragua came online last quarter. Like their EBITDA should be growing. They do plan on selling their Jamaica business. I don't know if they're going to sell half or sell all, but they want to raise $2 billion and retire $2 billion worth of debt. And as interest rates come down, then those prices should go up, right? Because they're selling essentially a fixed income. With the long-term natural gas purchasing contracts and the long-term electricity sales contracts, they essentially created a fixed income stream. And as the 10-year Treasury falls, the benchmark falls, it becomes a much higher price they can sell it at. So, but I don't think they're not pressured enough. It's not a fire sale. They wouldn't sell at terrible prices. It should be a, you know, pretty good sales if they can. We even saw this with Medical Properties Trust. One of the ways Medical Properties Trust raised money to deleverage is they took a group of hospitals in Utah and they sold 75% of it. So they retained 25% ownership. They are managing it. They're charging the passive investor a management fee, but then they sold 75%. I think you're going to see something like that happen in Jamaica, where they're going to, you know, keep some of it, charge a management fee, and then sell it not to a competitor. They're not going to sell it to Golar LNG. They're going to sell it to a pension fund, or they're going to sell it to somebody like a life insurance company, somebody who wants that fixed income stream. I know that there are a lot of bullish charts right now in small caps because the sell-off was so overdone. There's a lot of things that I think are really poised to break out. Another one of those would be SoFi. SoFi, I think, has a very good chart right now. And again, same thing, right? Massive sell-off. It's bounced off the bottom. SoFi's bounced off the, you know, $10.89 mark. Now it's back up to $12. Now it was at $17, $16.50. But again, you're coming off of this massive sell-off. And I think the small caps rebound first, and the small cap rebound has started. So the individual names like SoFi, like New Fortress Energy, I think the worst is behind them for a while. You have the RSI hitting oversold last week. MACD is improving, not flipped over into positive yet. But yeah, I like the look at this one pretty well. It's bounced off of the lower Bollinger Band. It just touched the 200-day moving average. So that bouncing hard off of the 200-day moving average is a very positive sign. And it's nowhere near a death cross. So I think things are looking good for SoFi. Things might not be looking as good for the energy names. Let me look at Vermilion Energy. Yeah, well, there's still a bouncing off the bottom. But you still have the 50-day below the 200-day, and no sign of positive momentum for those names moving averages to come together. But it's still a bounce off the bottom. That's what's amazing is the Dutch TTF gas prices are so high, and European natural gas storage is so low. And as far as whatever kind of peace deal takes place between Ukraine and Russia, I have a hard time believing that Europe is going to re-embrace importing Russian natural gas quickly. I think we have at least a few years before that happens, because I think you're going to need a new batch of politicians to come in and say, look, we aren't the ones who caused the Ukraine-Russia situation. It's not our fault, and we want that Russian natural gas. The current batch of politicians are married to the Russia is evil plot. So I think it's going to take a few years. So for a few years, I think Vermilion Energy can still make enormous amounts of money on their European natural gas. And their drilling programs in Germany have been so good. They just had a 100% hit rate, and they proved something like $1 billion worth of natural gas at current prices of new reserves off of their drilling program. So, and the new German government, rather than make a coalition with the AfD, they included the Greens in their coalition. And the Greens have been targeting American LNG, looking at the carbon footprint of liquefaction and regasification. So they might be much more friendly to gas that's drilled in Germany as opposed to the imported LNG. So we'll have to see, but this name has been so punished. Even Vermilion has a bounce right now. What else? Portillo's has been holding up well. It's had a drawdown, but not nearly as bad as some of the other names. So it's had a drawdown from 15 to 12. This one is not showing a sign of a bounce as much as some of the other names, but I think that is, yeah, there was a hammer candle on Friday. So that Friday made a hammer candle. That could be a short-term bottom here. That's a hammer candle. It's on the lower edge of the Bollinger Band, but it's below the 50-day moving average. But you have the golden cross that took place in the middle of February, where the 50-day moved above the 200-day. But we'll have to see if the Portillo's rises above the 50-day again. You have it getting very close to oversold. So if it hasn't already bottomed out, it's getting pretty close to where it's going to hit the oversold on the RSI. MACD isn't showing anything too fantastic. What else? Let's see. The offshore names have been just destroyed. Although even those caught a bounce in the beginning of March. So Transocean was at $2.60. It's bounced back up to $3. Just so many things had gotten so oversold, they needed a little bit of a bounce. And almost every small cap looks like that. So again, I think the story is the converse of saying they come for the generals last. Means they come for the small stuff first. And I think even if the worst isn't over for the Magnificent Seven, even if the worst isn't over for the NASDAQ, and even if the worst isn't over for the S&P 500, I think the worst is probably over for a lot of these individual names in my portfolio. Let's see. Gold has been very strong, but Equinox gold has been less strong. It is doing okay. It's out of this $5.50 range it was in for a long time. If I wanted to annotate this channel, right? So it was in for a long time. We'll call the channel here between 510 and 640, maybe between 5. But it was in this channel for a while, and I think it's I think it's broken well out of that now that it's going to be above the $6.50 range. But it is not doing as well as I would have thought it would do, considering that gold hit $3,000 an ounce. Let's see. I have stealth gold through Sibanye Stillwater. Sibanye Stillwater, that had its bottom in the end of February, beginning of March. That's bounced back from $3.10 up to it touched above $4. RSI is not quite overbought, and the MACD is in positives. You're nowhere near a golden cross here. This is still an overall declining chart, but I think the bottom might be in for most of these small cap names. And Sibanye Stillwater, they mine 700,000 ounces of gold in a year. 700,000 ounces of gold selling at $3,000 an ounce, as opposed to $2,200 an ounce. That's 2.1 billion in revenue. If they do 700,000 ounces over the next year and they sell those at an average price of $3,000 an ounce, that's 2.1 billion in revenue just from the gold. And meanwhile, it's a platinum group metal miner, but the platinum group metals. So the theory is that the prices have been pretty suppressed. One is just because of inventories, but two is the argument is Russia is selling their byproduct palladium to fund the Ukraine war. So Russia will stockpile palladium from Nornickel because they get palladium as a byproduct from their huge nickel mines. And then they build up that stockpile for when they need it. And for the Ukraine war, they've cracked open the piggy bank, sold the palladium. Chemists have found a way to substitute platinum for palladium, but chemists have not found a way to substitute platinum or palladium for rhodium. And check out what's happening to the rhodium prices. And if you guys have been watching Trader Ferg, so Trader Ferg was the first person who really caught on to this that I saw. And that was that rhodium is the platinum group metal that has no substitute. And beginning of March, it was, you know, it shot up from about $5,000 an ounce to past $6,000 an ounce, and it's come back down. But something is happening in platinum group metals. It's not a lot yet, but it's something finally happening. There's some sort of demand pull, that there's something in the platinum group metals that people want to buy, and there just, you know, was a short supply of it for a moment. So if I go back to the long term, you know, rhodium selling, you know, rising from 4,500 an ounce to 6,000 an ounce. It's just a drop in the bucket. In the last bull market for palladium, or for platinum group metals, it was 30,000 an ounce for rhodium. And a lot of people are speculating that this time it's going to get to 40, 50, $60,000 an ounce, because rhodium, it's the, out of the 3 platinum group metals, there's also a couple like iridium is in there, there's others, but as far as the platinum group metals that are used for catalysts, rhodium is the one that there's no substitute for, and it's also the most rare. So only about 6.5% of the platinum group metals mined in South Africa are rhodium. And so now the platinum group metals, they're used to clean up exhaust in automobiles. And a lot of poor countries that you think that they would cut corners on environment, they're so population dense, they can't cut corners on car exhaust or everybody starts dying. So places like India, places like Indonesia, places that are poor, you think, hey, they're going to cut corners on these environmental things. They're not going to cut corners on the catalytic converters for automobiles, because the exhaust is just, the population density is so high, it just kills too many people so fast. So that's the argument for the platinum group metals thesis. And then again, Trader Ferg was the first to bring this into the sort of the conversation, was that the hybrids use about 15% more platinum group metals than internal combustion vehicles. And on the earnings call for Hoeg Autoliners, they mentioned that they had expected weak automobile deliveries from China to Europe because of the European tariffs on electric vehicles. And Hoeg Autoliners said that China was able to retool their automobile manufacturing overnight from electric vehicles to hybrids, and that the exports of Chinese automobiles to Europe is strong with high volumes, and there's all hybrid vehicles. So as China builds out more hybrids, anyway, this is just the first inkling, the first indication that platinum group metals are starting to come back. And they've only just started. Palladium, still not much happening in palladium. Again, this price is very suppressed. And then platinum. I actually think platinum has a better chance of, so in the past, platinum was staying around $1,000 an ounce, while palladium was around $2,000 an ounce. And I think it could be the opposite this time, because platinum has a demand in jewelry and in precious metals, while palladium is much less common. Palladium is almost all for catalysts. Now that the price of gold is $3,000 an ounce, at some point, as the price of gold rises, you have a demand for the poor man's gold. And the poor man's gold in the past was silver. But who wants to carry like a kilo of silver? If you have platinum at $1,000 an ounce and you have gold at $3,000 an ounce, if gold goes to $4,000 an ounce, people are going to look at a $4,000 ounce of gold and say, maybe I should get maybe 2 ounces of platinum. And Costco is selling 1 ounce platinum ingots. And there's only about 5 million ounces a year of platinum mined. So just the demand from Costco, right? If the typical Costco shopper looks at $4,000 gold or $5,000 gold and says, I can't do it anymore, and they start buying, you know, $1,000 an ounce platinum, I think platinum could go from 1,000 an ounce to 2,000 an ounce, even if palladium stays flat. And that alone would bail out all of the platinum miners. I mean, if platinum goes from 1,000 an ounce to 2,000 an ounce, then Sibanye, Stillwater, Impala Platinum, Anglo American, they all become massively profitable at those levels. But again, just the first inkling that anything is happening in platinum group metals was rhodium, and it just all of a sudden just ticked up and started to get some attention. So we'll have to see what happens. But the only demand for rhodium is in catalytic converters. So the demand for catalytic converters is coming back. We'll have to see. This is it's not enough to make a trend line, but it's something. So that's Sibanye Stillwater. And again, 2.1 billion in revenue from 700,000 ounces of gold mining. And Sibanye Stillwater has a lot of gold mines that have been put into care and maintenance, or they've been discontinued because the price of gold was $1,800 an ounce. A lot of those at $3,000 an ounce, $3,500 an ounce, they could be mined profitably again. But you have South Africa problems. Let's see. For falling interest rates, I've got two positions. Douglas Elliman, which, you know, it's not really showing much of anything. It's been trading in the sideways channel for a long time. But Rocket Companies is much more interest rate sensitive. I called attention to it pretty close to the bottom here, and it's been grinding higher. It's been doing very well. They just announced that they're buying Redfin. They're doing a stock-based acquisition for Redfin, and I think that's fantastic. You know, to be able to get this mortgage origination. I mean, you look at their if you look at the cost of mortgage origination, about half of it is marketing. So if they're buying Redfin for $1.75 billion in stock, it doesn't take an awful lot of mortgage originations that have kind of zero commission, right? They're mortgage originations that don't have that marketing spend before that acquisition pays for itself. I think that's fantastic. I think it's going to be amazing. So you have not just falling interest rates, but the new Redfin acquisition and digesting that. So again, it's come off the bottom. It's not $10 anymore. It's $15. But I think I'd be a buyer of Rocket Companies. Anything under 20, I think it's going to be climbing back up there, at least in the near term. I mean, longer run, this is a stock with a very small percentage of the ownership floated, so it's highly volatile. So it attracts a lot of meme stock characteristics. So it has big ups and downs. This is what they call a hedge fund hotel. This is a stock for traders because it has big swings up and down. But I think it's 15 on its way back up to 20. As far as putting a long run valuation on it, you know, I think the long run valuation will be much higher. But in the meantime, this is a highly volatile hedge fund hotel. This is the thing you can get into and out of and have a lot of fun with. But we're entering a period of falling interest rates, which is going to mean more home equity loans, which Rocket Companies has a big market share in. So I like it a lot. Let's see. Some things are not working, right? Logistics still is not catching a bid. Logistics has been just beaten down and crushed. That's Heartland Express. It's new all-time lows. Meanwhile, they've paid down an awful lot of debt from the acquisitions they've done. Is this? Yeah, wow, new all-time lows. Look, trucking is a cyclical business, and the cycle has already turned. Right, they're already out of the worst of the cycle. The cycle, I think, is going to be stronger over the summer. It's going to take some time for positive results to come in, but the worst of the cycle is already behind them. But the worst of the stock price is just hitting them now. So I think this is probably, you know, I'd have to imagine the bottom is going to be in for Heartland Express. But this is, from a technical point of view, it's not showing any momentum. It's just, you know, it's bounced for a day. Is there a hammer candle there? Not really. Not really a hammer candle. There was a hammer candle here, but it wasn't. It didn't mark a bottom, unfortunately. Nothing with technicals works every time. But Heartland Express, yeah, I just like the fundamentals of the company. I have a write-up on my Substack. Cardlytics, I haven't listened to the earnings call yet, but the new management team came in, and I think they've stopped the bleeding. So I'd have to, again, I'd have to go check that last earnings call, but I think just on a quarterly basis, they had stopped hemorrhaging cash on a quarterly basis, which is huge. So I think I bought Cardlytics back here in the 350 range, and it's been sideways to down since then. But there's some glimmer of hope coming out of Cardlytics. On the biotech front, Perspective Therapeutics had I think a pretty good investor relations day in early March. So I'll shorten this up to the 3 months. Looks like they bottomed out in early March, and they've been climbing back ever since. But they had a lot of upgrades. They had a big investor relations day, and a lot of analysts have upgraded them. So I think management really took the time to communicate to the analysts what was going on with the company, and there were a lot of upgrades. Now there's not a lot of stock results yet, stock price results, but they have a lot of drug trials ongoing. It's just a matter of when the next chunk of data comes in that I think is positive. And it's just a matter of them explaining to analysts how to interpret the drug trial results, what's positive and what's not. My other biotech, ours, Pharmaceuticals, looks like they bottomed out at the end of February. They've been climbing back. I think the last time I talked about them on an earnings on one of these YouTube videos, it was in this climb here from January. It's been chopping sideways. The overall trend, right? The overall trend doesn't look fantastic. Yeah, that's a little bit too chaotic for me to call that a bull flag. I'm not going to go out on a limb and call that a bull flag. There's a lot of chopping sideways, and you do have now a death cross. You have the 50-day crossing below the 200-day, but you have the stock price now holding above the 50-day for a couple of days. I know fundamentally it's a great thing. I think everybody in that space knows that EpiPen is going away, and it's going to be replaced. And their competitor, which is I think AQST, they're still a year away from getting approvals for their mouth strips. And I was watching just randomly on YouTube. There was somebody with a opioid overdose, and so they were watching the emergency personnel, and they used the NFE nasal spray. So ours Pharmaceuticals, they have the patents for their nasal spray delivery mechanism, and just accidentally I was watching this video, and they used their patented nasal spray mechanism to deliver the Narcan to this guy who had overdosed. And I was just thinking about how to do that. If you really can't get the mouth strip in somebody's mouth if they're not cooperating. You don't want to be prying open somebody's jaw. And if somebody's going into a big anaphylactic shock, how cooperative are they going to be? Are they going to be conscious? Are they going to be biting your fingers off? I think that the people that are really gung-ho on the mouth strips, I think they're missing a lot of the basics of the drug delivery mechanism. I think the nasal spray is just gonna take that market share pretty aggressively, but that's just my opinion. Applied Optoelectronics, so they just announced. So this stock sold off hard, and not only is it a small cap, but it's a small cap exposed to the data center build out, and that's both are under pressure right now. But they just announced a new relationship with Amazon, and Amazon now has $8 million worth of warrants that they get as volume is taken up on a $4 billion contract. So as Amazon buys $4 billion worth of parts from Applied Optoelectronics, then Amazon gets to receive something like $8 million worth of warrants staggered over time. This is a fantastic contract for Applied Optoelectronics. So it was a brutal sell-off. I mean, all these things that looked like they were setting up for, the patterns were breaking down. So I would have said here that this is a bull flag in consolidation, but it didn't break out, it broke down, right? So a lot of these technical patterns, it looks like a bull flag, but then it failed, right? It it didn't continue the next leg up, it actually continued down. But the fundamentals can overtake that. And that $4 billion Amazon contract, that is a big honking deal, right? For a $1 billion market cap company to have Amazon interested in buying $4 billion worth of your products. I don't know the technology well enough to know how many competitors they have, but when I last wrote about them, they had contracts with 3 out of the 5 hyperscalers. And now you add Amazon on top of that for $4 billion. It's a pretty good bull story. I think I bought in around here at the $15, $16 range, and then it bumped up pretty nicely. I sold calls because I thought that this was overdone and that the gap would get filled, and it did. So the calls that I sold now expire in 5 days, and I think I've got calls sold at 35. I think those calls are going to expire worthless, but I think now it's probably off to the races. If this, I'll go back to the S&P 500. If we are towards the end of this sell-off, right, if the bottom is in, and I'm less sure the bottom is in for the S&P 500 than I am for a lot of the individual small cap names, but if the bottom is in and we start getting some positive momentum here, especially in the data center build out, Applied Optoelectronics will just, I think it'll break this past high pretty fast here. So I don't know where it's going to open on Monday, but that I think that's a pretty good buying opportunity. Let's see, Applied Opto. The whole uranium space has been pretty beaten down. Centrus Energy. Centrus Energy is the one uranium enricher. I don't know what to make of this chart other than it's been chopping sideways for a while. It's huge attempts to break out and then consolidating, chopping sideways. I think it's still a good buy here. But as far as uranium, so there's 3 levels. There's the miner, there's the conversion, and there's the enrichment. And as I was doing the research into where I wanted to choose my spots in the uranium market, there was no way to invest privately in uranium conversion, in private, because you have competition from these government companies. You've got Orano from France. You've got all these essentially government industries, where Centrus Energy was the US government, but then they privatized it. So ConverDyn is the only company that owns a private uranium conversion facility. The uranium ore from the ground has to be converted into uranium hexafluoride. Then the uranium hexafluoride is enriched. The only private uranium conversion facility is owned by ConverDyn. ConverDyn is 50% owned by Honeywell. I'm not 100% sure. I need to dig into it and make sure I know the details, but Honeywell is going to split itself up into 3 entities. And the smallest of the 3, I think the ConverDyn ownership stake is going to be in the smallest of the 3. So it'll be a small cap. It'll be a $3.5 billion market cap company that's going to own 50% of ConverDyn, which has the only private uranium conversion. So I might have for you at the end of 2025 a new spot to pick in the uranium market, from your favorite miner to your favorite enricher to your favorite converter. And that would be the Honeywell spinoff, which is only about 10. Honeywell is too big to own for uranium conversion, but the spinoff that's only going to be, I think, Honeywell Materials, is only going to be 10% of Honeywell, and it's going to be about a $3.5 billion market cap and own 50% of ConverDyn. And I think that's going to be an interesting place to be in the uranium market, because it'll be, a small cap with a large exposure to uranium. In a world where everybody's building out new nuclear power plants. So, but as far as Centrus Energy goes, again, you have this massive sell-off since the start of February. It's consolidating now over the last week. The bottom, this is a pretty good support area. You have some little bit of past resistance becomes future support. It's not perfect, but the bottom could be in on the short term for Centrus Energy. They especially as a peace deal becomes more and more likely between Russia and Ukraine, then it becomes more and more likely that Centrus Energy can fulfill the last couple of years of their contracts with imported Russian uranium. So I think things are looking up fundamentally for them, and they've won every one of the Department of Energy contracts that they bid on, but they're kind of a pay-as-you-go. So we don't know how many of this $3 billion are going to go to Centrus Energy. But if the right hand of the government knows what the left hand is doing, it should be the lion's share going to Centrus Energy. Because again, the big thesis here is non-proliferation treaties say that the US government can only buy uranium from an American company. So it has to be an American company with an American supply chain, American sourced. And right now, Centrus Energy is the only company that has that. So even though Orano of France bid on some of these contracts and won them alongside Centrus Energy, it's a pay-as-you-go system. You know, each one who won gets a minimum payment of $2 million as they perform work, but then the rest of the $3 billion gets doled out. Well, if the Department of Energy knows that the Department of Defense needs a US-sourced uranium enricher, why are they going to give more money to the Japanese enricher? Why are they going to give more money to the French enricher when they can give more money to the American one? So if the government agencies are coordinating in any way whatsoever, the lion's share of $3 billion should go to Centrus Energy. But if it's just a bunch of government waste and payola, I still have a hard time. The Department of Energy is eager to just give a bunch of extra money to the French. But anyway, that's the situation with Centrus Energy. I think it's relatively cheap here. Pretty much everything is relatively cheap here. It has been a rough time. There's not a lot of things in my portfolio that are up. Small cap tech has even gotten taken out to the woodshed pretty hard. Nerdy has been flat this whole time, and it's been flat this whole time despite aggressive buying from the CEO and the founder. Let's see. I don't need to put so many other names up. One of the biggest sell-offs was in Newell Brands. From $10 a share to $6. This is 30-40% drawdowns on, I think, very moderate earnings calls. And this one, it's not a huge bounce off the bottom, but again, it looks like the bottom could be in from the beginning of March. LFMD. So LifeMD had a pretty good quarterly earnings release. I haven't written up about that yet, and they're going to be competing against HIMSS and Teladoc. Teladoc's chart looks a lot worse. That one, the bottom might not be in. There's no positive momentum there. Colin works a lot more with the fund flows, and he was telling me that there's a lot of money flowing into Germany right now. I don't have any German stocks. The closest thing that I had for the peace trade for the end of the Ukraine war was this Central and Eastern Europe fund, CEE. Now they're majority Polish with a little bit of Hungary, but the Polish economy is super strong. It's just aggressive growth in the Polish economy. And if there's going to be any rebuilding of Ukraine, there's going to be enormous industrial support coming out of Poland. And the same thing, so maybe the best way to be exposed to the Germany reindustrialization from this new defense spending, Poland is a lot like Canada to Germany. So Canada to the US, Poland to Germany, where the components are made in Poland and the final assembly might be done in Germany. So this Central and Eastern Europe fund, which has huge exposure to Poland, is going to benefit from both the German defense spending and the Ukraine rebuilding. So I really like this stock a lot. And plus, they have this portfolio of Russian stocks. They had exposure to Russia before the war, before they were all brought to zero. And they have sold some of them, but the ones that they're not allowed to sell are still on the books. And so if there's a reunification with Russia and those securities are allowed to trade again, if I look out to 5 years, so this is the drop off. They were $25, $23, $24 a share, and then their Russian stocks were zeroed out, and they dropped to $7 a share. They've been climbing back. They're back up to 15 now. I think just on the chance the Russian stocks get revalued again. If the Russian stocks get revalued again, I think this is going to go from 15 to 20 real fast, just as a step function. They have sold some of them, and they didn't get very much money for what they sold, but some of them were not allowed to be sold. So I do like this Central and Eastern European fund. Let me take a look at what's going on with some of the South America stocks. So ever since Javier Milei pumped a meme coin on his Twitter account, El Cresud sold off from $12 to $10. I think it's a huge buying opportunity. It's so undervalued here. And then you have Ecopetrol in, where's Ecopetrol in Colombia? It is, there we go. Ecopetrol has been somewhat flat. How about, this might be too thin, no, too thin to look at. And then PagSeguro. PagSeguro has been chopping sideways a little bit. So it was down in the $6.50 range. Brazil had a big bounce for Brazilian stocks in January, February. But in the value sell-off, then they sold off again. I think it's still a great place to buy PagSeguro here. You keep getting closer and closer to the next election, where the current president of Brazil is probably too old to run again. But it's much less clear-cut in Brazil how the next election is going to go. In Colombia, the next election seems like a slam dunk that the current president is going to lose and the conservatives are going to take power. I had written about Bancolombia, and that had a huge gap up. I think it still has a long way to go, Bancolombia, but people are starting to price in the fact that the current president of Colombia is going to be out. And while he's there, he's kind of a lame duck. He doesn't have enough support to really get a lot done. And economies usually do pretty well when governments can't really get all that much done. So Bancolombia is not there's just not a lot of Colombian stocks to buy. I found one, but I'm going to have to buy it on the Colombian exchange. I wrote about it on my Substack a while back, but this website only shows American stock tickers. Yeah, that's about it. A lot of stocks have been cut in half. A lot of them. It has been a brutal time in the market. But I'll go back to the S&P 500. Well, at the end of the day, when you're at extreme fear and the VIX is over 20 and you're in a bull market, and if you zoom out, we had this bear market from rising interest rates, and now we're in a period of falling interest rates. The dominant theme is we've got productivity growth from artificial intelligence. We've got a tailwind from a business-friendly government with deregulation and tax cuts. It's really hard to convince me that we're not still in a bull market. And if we're still in a bull market, then this is about as much sell-off as needs to happen. It could still keep going down a little more, but I would be very surprised to see a 20% drawdown in the S&P 500 in a bull market while credit spreads are tight. That would be a very rare event. I think the most likely outcome is, now that we've reached peak put buying, I think the worst is over, and we can go back into the expansion. It has been very, very painful. And again, people are anybody who says it's painful, they get criticized on Twitter. Oh no, a 10% drawdown, boo hoo hoo. But it's the individual names that are down 30 or 40%. And a lot of individual names are down 30 and 40%. So I think very few people's portfolios are down only 10% unless they're only in the S&P 500. And those of us who are trying to outperform that are in individual names, in small cap names. And it has been much more painful. And especially in small caps, because again, small caps had never really recovered in order to fall 20%. And if I annotate this to this, yeah. So we were at this world where past resistance can become future support. I was very happy to be above this line, and kind of surprised when we went crashing below it again. This is, I mean, where are we at? We're at almost a 5-year break even on small caps. That's not a fun place to be. But again, individual names are very, very different. And well, that's all I have for you this week. Thank you for watching. My overall theme is that they come for the generals last. And if they come for the generals last, it means they came for the small caps first. And if they came for the small caps first, small caps, I think, are very likely to lead out of this correction. And so it's, I think it's a very bullish time to be investing in small caps, although the drawdown was very, very painful. So I would not be surprised if the Magnificent Seven sold off more. I would not be surprised if the S&P 500 sold off some more. I would be surprised if small caps are going to fall more than the 19% they've already fallen from peak to trough. That would be a surprise. I think they're going to come for the generals last, and the small caps are already bouncing out of this trough. So that's my take on the market right now, and I am easily wrong. But thank you for watching anyway, and hope you guys have a great week.